Hello everyone, I'm James Turk. Welcome to this annual Goldmoney Roundtable for 2019. I'm here in London today with several of my colleagues. On my right is Roy Sebag, who's the CEO of Goldmoney. Next to Roy is Stefan Wieler, who's a non-executive director of Goldmoney. Our special guest today is Ned Naylor-Leyland, who's with Marion Global Investors. Next to Ned is Alasdair Macleod, Director of Research of Goldmoney. And to my left, John Butler, CEO of London Borough Trust Company, which is a Goldmoney affiliate. Roy, how do you see 2018 before we get into 2019?
Yeah, it was certainly a great ending to the year as regards to precious metals. We saw gold and silver rally really the last 2.5 months quite aggressively. And I think things are positioning really well, surprisingly well for 2019 when we consider all the variables and really the fact that interest rates in the United States are so high and gold has really been stable over the last 5 years.
Is that going to be the big driver in 2019, interest rates?
I think so. I think definitely one of two things has to happen. Either the rest of the central banks around the world begin to raise and normalize, in which case that won't bode well for gold, or we will see sort of the Fed stop playing this game of poker that they've been playing and return back to easing and then getting into some of the real problems if we see the deflation continue and the U.S. recession take hold.
One of the things that I've been focusing on is the total U.S. debt and the interest expense, which has been going up considerably as interest rates have been rising. Do you see that as a big factor in 2019?
It's always a factor. It's like that Mark Twain or Hemingway joke, how do you go bankrupt a little bit and then all of a sudden, and that's always the big fulcrum issue when a government can't finance its own existence and has to rely on bringing consumption forward or mortgaging the future. But in this case, I really feel like the dynamic has more to do with the central bank action rather than the nominal debt that's outstanding. One of the most interesting signals that I noticed in the last few weeks was that the volatility in the equity markets really began the day that the ECB stopped purchasing new bonds. And I wonder whether that has reverberated through the central bank echo chamber.
Let's open it up. Alasdair, what do you think?
It's interesting. The interest rate thing, I don't think, is a negative for gold. Rising interest rates, I don't think, are negative. History tells us that. But I think you can get there by comparing gold with physical cash. I mean, if you've got Kruger rounds in your pocket, they don't earn you anything. If you've got pound notes or dollar notes in your pocket, they don't earn anything either. But there is an interest rate on gold if you want to borrow it or if you want to lend it. So in a sense, I think that rising interest rates, what really matters as far as the gold price is concerned is, are interest rates rising at a pace which is going to soften the economy and make, if you like, fiat money more attractive relative to gold or not? And I think that's the issue. And that, of course, is a moving target. It's changing all the time. I think going from now, I mean, what we saw in the last month or two is, I think, a global slowdown, almost a stoppage, if you like, in some markets. Now, this, I think, is going to set the scene for 2019. We're going to have the big risk, I think, is maybe moving into a slump, because there are a number of factors that are coming together, which I'm sure will come out over the course of this conversation. But, trade policies, the fact that the ECB can't get out of its monetary dilemma in the face of a downturn. The Fed has been forced to stop reducing its balance sheet. All these factors tell me that things are coming to a rather nasty stop. And the more I look at the comparison with history, I sort of come up with 1929 to 1932. Now, that is extremely worrying, and hopefully that won't happen. But there are so many similarities, if you like, in the situation that's developing today that any economic historian should be concerned.
The big difference, of course, back then was that national currencies were tied to gold. under the old gold standard. Today, they're not tied to anything. So that's worrying if you're holding currency.
Well, no, you're right, James. That is the big, big difference. And of course, what happened in the 1930s was the price of commodities and agricultural product and all the rest of it fell very, very substantially in gold terms. And that was replicated through the gold exchange standard that existed with virtually every major currency at that time. Nowadays, you don't have that. So what happens to the currencies? The purchasing power of currencies is likely to decline for the very simple reason that the authorities are absolutely terrified of an economic slowdown. They will do anything they can by monetary means to ensure that it doesn't happen. Whether they succeed or not, we will only know after the event. But what it does mean is we've got another round of currency debasement developing now.
So what you're saying basically is that national currencies will inflate, gold will deflate. In other words, prices will go up if you're looking at prices in terms of a national currency, but prices will go down if you're looking at commodities in terms of gold. In other words, the gold price will go up in terms of national currencies.
Exactly that.
Ned?
Well, look, I mean, I agree with that. I think there's a danger that we're all going to just agree with each other about everything. But I do agree with Alice's point about relating gold to the cash market. The way I see it is I'm always thinking about the nature of the way gold trades in the cash market and the fact that it's really the inverse of real interest rates. And at the moment, the way I'm describing it is that it's sort of 6.5, 7 years that the Fed has been promising a very slightly uphill trajectory in terms of real yields. That's to say, promising normalization, promising rate hikes, and that keeps the cash market away from gold as a hedge against loss of purchasing power. They've been quite clever in the way they've managed that, really, and they've kept it just slightly uphill all the way through, and the bond market's bought that narrative. But I think that did dramatically change in December. I think that it's quite clear that then tilted to a sort of level playing field, and even since then, maybe even slightly downhill, what with the leak last Friday about the pace of QT and also central bank balance sheet growth we've seen in the last month as well. So I think it's always about that, and I'm obviously quite excited as a result, because I think it does look as though what's been that slight headwind for 6.5 years of promising, oh, we can do this, we can go back to normal interest rate policy, we can go back to a normal environment. That seems to have lost its legs lately, and for me that dominates. I think the other thing to bear in mind is gold as money, which of course I know we're all interested in, and not to excuse the pun on purpose, is really a cyclical thing, but a very long cycle. And I think right now we've all been interested in gold. James, maybe back actually in the raging winter when absolutely no one was interested in gold beyond the odd person in the central bank. But I think we're now sort of mid to late spring in terms of the gold as money cycle, and I think it's warming up pretty quickly, and people will be surprised how much that can burst out into full view, and obviously policymakers' comments are supporting that as well. Subject which they never wanted to talk about is starting to edge out there into view.
We have with us today Stefan, who's an expert in the energy market. So when you're talking about gold, energy is the other side of the same coin. Do you want to just bring us into
yeah, sure.
your thinking, 2018, 2019, on the energy markets?
Yeah, so just to take a step back, we developed this model a couple of years ago where we basically show that you can explain the large moves, or actually even the small moves in the gold price by practically two factors. One is real interest rates and central bank policy such as QE, and the other one is longer dated energy prices, because such a big share of production costs of gold is actually
longer dated energy prices going out, what, 3 years, 5 years?
So yeah, so the way we look at, the way I look at the world is that there's not really one price of, let's say, oil or gas, but there's an entire curve, right? There's like, you can buy prompt, you can buy 1 month forward, you can buy 5 year forward. And really, the production cost of any of these energy commodities, and basically any commodity, you can really only see this at the very back end of the curve. That should be the marginal cost of future supply. That should not basically move much, unless you have a massive shift in technology, as we have seen with shale a couple of years ago, or you have a massive shift in like the trajectory of global economic expansion, so that you basically say, oh, we just don't need that much of that stuff anymore going forward. But usually that is kind of where, over the very long run, where the market says, okay, that's where we need oil prices or gas prices to be, that we can bring enough new supply online to deal with decline rates and deal with growing demand. And what we found is that gold very much reacts to this part of the curve, to the very back end. We used in our model, statistics in the end, we used the longer dated oil prices of 5-year forward as a proxy for energy prices. But we all know mining gold is not just oil, it's energy in all kinds of forms. And so if you look at that, we can really say, whoever, like, if you follow the oil prices over the past year, you saw actually a tremendous rally going into the third quarter and then a total collapse. So we went to over $80 in Brent and then collapsed to $50 on Christmas Eve. That has very little to do with production costs or anything, because the back end of the curve remained at $60. It just doesn't really move much. So I think in order for that to move, you need to see either two things. You need to see broad-based inflation, cost inflation, which is something that we'll see from all the monetary experiments we have been doing over the past 10 years. Or the other thing would be that the market realizes that at $60 you're not getting enough oil to supply the world in the next 5 to 10 years, which is what I think is going to happen. And the reason being that the entire world is relying on the United States to supply the entire production growth over the next 10 years. So that's basically what's currently priced into the market, is that this back end being at $60, that the US can supply the world. Like all the decline rates we see in the rest of the world, plus all the demand growth we've seen over the next 10 years, US shale drills will be there to supply that. And I think it's very unrealistic, simply because they're not making any money at this price. So they produce, and all they can do is they produce enough cash flow to actually service their debt. And so the banks are now basically rolling over their debt because they don't want to write it off. But nobody makes money. And definitely nobody made money at $80, and definitely people don't make money right now in the US. Depending on where you are, you're making $45, not even. So I think at some point the market will have to realize that. I think by that time it's too late, and then that back end will have to move higher. That is what actually is then the energy driver of the gold price. I don't think, it's really hard to predict this stuff, so I don't think this actually will be the 2019 topic. This probably is going to be a bit further out. So for me also, the driver for 2019 is really what's going to happen with real interest rates. And there we are back to exactly what you said, right? So the whole world was buying into this Fed narrative that they will gradually raise interest rates. And if you say normalize, when we say normalize, they actually promised us to raise it to 3%. That's not normal. And we have always argued with our model that at 3% and 2% inflation, gold price is still going to be $1,300, right? It's like, that is already priced into the market. So the very best they have promised us, if that would have happened, gold prices wouldn't have moved lower. But now we have this shift since December, and you see it in the Fed funds futures market, that the market is now heavily discounting these future rate hikes. And they can't, because if you look at the world, you look at PMIs in China, Europe, you look at Chinese car sales are down for the first time in 30 years. You look at, we have an inverted yield curve now. All these things, it's very, very unlikely that they're getting to the point that they can ever raise it to this promised 3%, which wouldn't have been bad for gold, in my argument. And now they have to cut at some point. So, yeah.
But how do you cut when interest rates are?
On average, so if you look at over the last 30 years or so, on average, when we went into a US recession, and by the way, we're only 6 months of the longest period of no recession in the United States in history, they cut interest rates by 5.5% on average. Now, last time that wasn't enough, right? So they had to, because they went to 0 at 5.5, they had to launch QE and everything. So now we are at 2.5. I mean,
we've got $7 trillion worldwide of negative interest rates. I mean, how can you cut interest rates when you already have something like that?
You necessarily will have, even if it's a normal, not like an extreme recession like we had in 2008, and I think we all have our views how that will play out, but if you just have a normal recession, there's not enough slack that you can actually cut rates that much. So you almost necessarily have to revert back to some sort of, we used to call this unconventional monetary policy, but we're doing it for 10 years right now.
We never
so
really left it.
It's really not unconventional anymore, right? So, yeah, it's going to be something like this, or when we go more extreme, we go straight to helicopter money, something like this. So
what do you think?
I think eventually...
But this, I think, is what makes where we are today qualitatively different than any cycle, any recovery that we've lived through. Because, yes, okay, leading indicators, a handful of which Stefan just mentioned, are rolling over. And we see all this typical late end of cycle signals in the data. Okay, so we're getting into a slowdown. Central banks are beginning to acknowledge it. Okay, but where did this whole recovery come from? It was all engineered. It was all artificial. It was all unconventional. And so we're in this odd situation where as financial markets begin to quantitatively reassess their expectations, they also begin to peer behind the curtain again. They see the man behind the curtain who's been pulling the levers the whole time, just like Toto and Dorothy in The Wizard of Oz. And they need to go through a qualitative reassessment. Where did all this growth come from? What qualitative, unconventional factors really kickstarted that recovery that carried us through basically all the way to the present day? And therefore, the potential for a reassessment to the downside for growth, for risk premia, for all kinds of things is unusually high today. And also, we must also not forget that a lot of the debt that was originated during this cycle has been supporting various structured, leveraged, and illiquid products for which, as long as the price level is still rising in general for assets, that's okay. But that sort of liquidity is directional. The moment the prices stop increasing, and God forbid they start falling, the liquidity evaporates very quickly. We learned this in 2007, 2008. And the potential for something similar, yet larger, to happen today is actually quite high. Gold's the antidote to all of that. Gold is the anti-asset in that sort of modern sense of being something that is leveraged, potentially directionally illiquid. And so I think we're going to see not just sort of this quantitative reassessment of gold that's very positive over the course of this year, but almost some qualitative shock value that will drive some additional demand into gold over the course of the year.
That's a great point. So, we're sitting here at the Royal Society where Isaac Newton published his Principia Mathematica, which was essentially this treatise on, the laws of gravitation and motion. And as many of you know, I actually learned this from James. Isaac Newton tried very hard to convert various elements into gold through alchemy. And eventually, whether this is a central cause or not, we know that he was the founder of the Bank of England, the first central banker, essentially. And in a way, the reason I mention this is that I don't think that in a fiat money economy, it's the actual debt in terms of the dollars that's important. But these days, I think there's almost this intellectual balance sheet where a central banker or an academic will put forward a debt in the form of a theory and say, look, I can do this and I can do that. But at some point, the theory does get weighed. And it gets weighed through either the natural order of things or through basically some competing theory, which comes into play. And I think what's so special about this moment is that we're sort of all realizing that on this intellectual balance sheet that the central banks and academics have, there is a lot of debt coming due in the form of promises that were made, in the form of predictions. Forget about growth and things like that, just actual predictions. And how they get out of this quandary may only be through an alternate theory. And I've personally been seeing a lot of rumblings about MMT, which is this modern money theory, which essentially just throws everything out the door, if I understand it correctly, and just admits, look, it's a fiat money system, which means the government can print as much as it needs. Forget about what Keynes says. Let's just start, getting the hose at the highest pressure possible. But it's okay. The government can control where it goes. And I really am interested in your views on this new theory, because for me, QE and TARP's critical problem was it wasn't an academic theory. It was never flushed out. It was never debated. There was no real literature about it. And this is just my intuition, but I personally feel that even Keynes, if he were alive, would be very angry with the way that his views were taken out of context about what Keynesianism is. I can't even imagine what the Austrians would be doing. But Keynes himself has really been taken out of context. And now you have this guy, Rails, the chief proponent of MMT, and I see a lot of powerful people getting around this theory. And I wonder whether what we're going to see isn't just inflation this time and QE, but a whole re-architecture of the monetary system. Ned, have you learned a little bit about this thing?
Sure. I'm probably not as well read on it as some people. I know Alasdair's been commenting on that as well. I think that it's an inevitable direction of travel. Speaking a little bit to what John said as well, for me, it's about narrative control more than anything else. I think they'll try that narrative, and I think they are trying that narrative. But what I notice, dealing with lots of people who are running money in fixed interest and equities around me, so I'm the sort of the outlier in all sorts of ways. But it's interesting to see that they're now, the guys in the fixed interest desk are not happy with the situation as it is now, let alone if MMT is pushed forward as a genuine outcome. And for me, I'll always look at capital flows. What are going to happen with capital flows rather than what a policymaker's going to try? I'm sure they're going to try all sorts of exotic ways of getting out of where they are, short of a reset. But I think the thing to watch is what does the people who actually deploying capital in the bond market, what are they doing? What are they thinking? And I know that there's certainly the people I'm talking to, there's acute nervousness already with the US setup, the inability to roll, and all those underlying structural issues which you're inferring are there. I don't know enough about MMT in and of itself. It seems to be rather amusing from the perspective of a gold bug. I don't know that much about it, but it seems very odd.
My fear in what I know about it is that MMT is that moment that you are no longer in capitalism. Like all of these attempts thus far, including Keynesianism, were trying to solve a monetary crisis or a recession or control, but still keep the animal spirits there as sort of the complex system which allocates capital, distributes capital. The MMT system seems to me to go hand in hand with socialism. But Alasdair, what do you think about MMT?
Well, no, you're absolutely right, Roy. MMT basically is a rehash of chartalism, which was invented, if you like, by an economist called George Knapp, and who wrote about it, I think, in about 1905, 1906, round about then. And basically, it's the state theory of money. The state should have the right to issue money, and the use of money in the private sector is not a matter for the private sector. So you're right to identify it with government control, if you like, over the economy. To me, people are rolling out this rubbish basically because they know that the existing monetary policies are failing, and for goodness sake, we need something. There's a bit of that, and you can see that people who don't understand money, let alone sound money, are attracted by this sort of wonderful idea that there is a new theory which is going to rescue us from everything. But if you go back to before the First World War, Bismarck used MMT, then known as chartalism, as the means of financing the state's expansion on military spending. And Germany, with the German historical economic theories, had actually been socialist for about 60 or 70 years before then, before the First World War. So, you know, we're talking about socialism, we're talking about taking things away from the private sector in terms of decisions, pricing, and everything. And what interests me is that the failure of chartalism, call it MMT nowadays, was actually so profound that it led to 2 world wars. I mean, the destabilizing effect of the First World War led us into the second one. So this is no solution at all. It's just an attempt to avoid the reality of sound money.
It's, I mean, just to summarize Alasdair's point a little bit, I mean, I came up with a new name for MMT, which I think is more appropriate, which is not modern monetary theory, but old...
Polite.
No, but not modern monetary theory, but old fiscal theory. The idea that back before we even had our modern monetary instruments that we use, that central bankers use today, the state, in theory, could always borrow money, could always engage in deficit spending. And this is basically just saying that that's a free lunch. There are no real consequences because you can simply monetize that if the state has full control of money. So it's really not particularly new, as Alasdair has pointed out, and it is based on the idea that fiscal policy management can and should be used, but used so aggressively that you monetize 100% of those deficits, if necessary, in order to achieve some arbitrary growth target. What it makes it impossible for an economy to do is allocate capital efficiently according to any reasonable capitalist assumption, and it also makes it impossible to save. And that is simply an arbitrary expropriation of wealth from the citizens.
Which destroys the middle class, which destroys capitalism.
Absolutely.
Because that's where the savings and production are that makes capitalism work.
Indeed.
So is this a trend that's going to stay in motion?
The way
Are we going to see a train wreck in 2019?
The way I see it, my intuition is that I was really hoping when I started to see how Jerome Powell was behaving that maybe they got it. Maybe they did see that all of this money debasing led to, you know, unequivocal bifurcated wealth effects. The rich were getting richer faster, social upheaval, political upheaval. I almost felt like they got the message. And that was why, even in light of Trump begging him not to raise, he kept raising. And if you listen to his statements as well, I mean, he talks about the middle class, he talks about savings, he talks about wage inflation. And then the market started collapsing in December, and the VIX started rising. And I also seemed to float in circles with a lot of these finance stalwarts, and you know, they were panicking right away. You know, what is this? What is this? We need to lower rates. We need to print money. And then I saw how gold just reacted the last few days. And I mean, that was a very strong candle that day, 2 days ago on gold. It was surprising.
And silver.
And silver. And that didn't seem like a natural price discovery for, like, I hadn't seen a candle like that in a very long time on gold. And so it almost makes me feel like the signal now is, heck no, we're going back to inflation again. And if you're going to go back to inflation, then it's going to be uncontrolled inflation. It's not going to be a controlled inflation. So this is where I'm always trying to be 2 or 3 steps ahead, because I think that, you know, these paradigm shifts are so important in markets, and you never know when the paradigm shift, the inflection point, you can never truly tell. You know, for example, and I'm digressing a bit, so we shouldn't spend too much time on this, but you know, all of a sudden Venezuela is so important. I keep hearing about Venezuela, and what we're seeing is essentially a coup d'etat in Venezuela, which, you know, is being done in the most interesting way through social media. Why is Venezuela so important all of a sudden? Is it because of the oil? Is it because of socialism? I see some of these political competitors from the left, whether it's Alexandria Ocasio-Cortez, who I've been talking about for a year, and people thought I was crazy, and I think she's literally on her way to becoming the next president at this stage. She's very popular. Or Elizabeth Warren, or Beto, or Kamala Harris, all of which are talking about a wealth tax. A wealth tax, which means that if you have X dollars in wealth, Y percentage gets debited every year, irrespective of your gain. And to me, that's also socialism. So I'm just wondering whether the real signal here is not necessarily hyperinflation the way we all think, but a complete re-architecture of the monetary system. And that's why I wanted to talk about it. It's clearly many years away from happening, but it may be that gold's rise this time around isn't necessarily because of real interest rates or energy, but because of this scramble to protect assets during this state of malaise until the academics figure out which direction they want to go and the politicians figure out which direction they want to go. And you know, gold could break to $2,000 or $3,000 an ounce just on that if you have a few years like that where Gilets jaunes continues and Brexit issues and issues in Venezuela and issues in China and issues in America. We've got another election coming. Mueller, you could see all of this just result in a much, much higher gold price. And I'll take just a few more moments. I was at a conference recently in Vancouver, and I was observing another panel, and in this panel, there was a guy who was pretty successful, and he was with Peter Schiff and some of the other kind of macro guys. And at one point, they were all debating whether the dollar was going to inflate or deflate the price of gold. And he kind of just stood and said, why do you guys spend so much time talking about this nonsense? I could just look at the chart, and when gold breaks out to 2,000, I'll just buy some gold stocks. And this isn't how you get rich, and this doesn't matter. And I was so taken back by this guy's assessment because he couldn't be more wrong about how important this moment is in economic history and how important it is for everyone, no matter how rich they are or how poor, to figure out and recognize what to do with their savings. It's not a function of watching for the $1,500 breakout with gold. It's literally a function of whether you will even get gold at that moment or whether you will even align yourself. These things are like the Titanic. They're very difficult to navigate. And I think that there has never been a more important moment to be a high-content consumer of economic information and theory and read the tea leaves, because there's a lot of stuff that's going on that 5-10 years ago I never thought would be happening in the United States.
Can I pick up on one of your earlier points, which I think is central to this argument? You said that Powell, you thought had actually got it, understood the importance of raising interest rates, but have subsequently been disappointed. I think Powell did get it. I think he does get it. His problem is political reality. Political reality is quite simple, and that is, if he continues with raising rates, then he will trash the US economy. For reasons we needn't go into, it's absolutely obvious. So consequently, he's been forced back by political reality. Now this, to my mind, sends an extremely important message to the markets, and that is that we are in the early stages of what could turn out to be monetary hyperinflation.
So
that is the key to it.
What you're saying is that Powell has a dilemma. If he raises interest rates, he saves the dollar, but if he doesn't raise interest rates, he trashes the economy and trashes the dollar.
Yes.
So he either saves the dollar or doesn't. You're saying he's going to trash the dollar.
It's a choice. It's a choice, in effect.
I think at this point it's just basically creating a narrative, right? From either side. It's basically you're setting up the blame game right now. Because if they see it's going to happen, and they know at this point, if Powell basically comes to the realization that he's in that situation, so he can't stop it, right? So if he raises interest rates a little bit more, the US will go into a recession. Maybe he already raised it too much and it's just unstoppable from this point. So now it's basically to set up the blame game. Instead of having people focus on Fed policy, and especially, it's not the Fed policy now that crashes the US economy, right? It's the Fed policy of the last 10 years that crashes the economy. Instead of having people focus on that, you say, well, this is because now we have these trade tensions with China, and that brought us into this situation. So it's a back and forth, and different actors try to create the narrative that when it happens, you can blame somebody else. And Powell is in that situation the same way Yellen was in it. She was just lucky she came out without crashing the economy, and Bernanke came out without crashing the economy. If anything, it blows my mind how resilient the US dollar system is, right? So that this didn't happen during Bernanke or Yellen's time. But it's exactly as Alasdair says. I mean, if he understands this, and I assume he understands this, then he knows the situation he is in, and he can't stop it anyway. So now you basically do the best and kick the can down the road as good as you can, or at least say, well, it wasn't us.
I think the contrast with the late 70s, early 80s is fascinating here because Paul Volcker will come in with a mandate to try and get inflation under control. The flip side of which, of course, is getting the dollar under control. The dollar was extremely weak at the time, and so he comes in with this mandate that we have to restore the Fed's credibility and obviously the credibility of the U.S. economy as a whole. And so he really sets about tightening policy and causes, up to that point, the most severe U.S. recession since the Second World War. But there is this understanding in the United States generally within the political system that while the pain was going to be difficult to endure, it kind of had to be done. The piper had to be paid from having been too lax with monetary policy in the 70s. So there was this general buy-in that the U.S. kind of had to go through this period to stabilize things. I don't see anything like that today. The narrative, again, is totally different. It's just a question of how much more do we need to inflate, how quickly to try and at least keep the party going. There's no sense of reckoning at all, in my opinion.
So I'm actually interested in your view, John, on this, and also in yours, Ned. How do we know that it is different, though? How do we know that they can't just lower rates by 1% or maybe 1.5%, keep it there, let the recession do its thing, and because of the economic policies of Trumponomics, we get growth, we get household formation, and we come out of it. I mean, what? And I'm playing devil's advocate, of course, but what would be your reason, the primary reason?
Well, I think what people misunderstand here is that because, as I said earlier, this whole recovery is artificial, it's all been engineered. What's resulted is a huge misallocation of capital, which you don't really see while the party is still going. But the fact is, all kinds of bad investments have been made, investments that ultimately are not going to be economically viable in even a marginally higher interest rate environment. And so sadly, a marginally lower interest rate environment still is not going to save a lot of that asset inflation from ultimately petering out and failing to continue delivering economic growth in what is a patently unsustainable way. So it's difficult to see these misallocations in real time, but Austrian economic theory has a very powerful way for nevertheless understanding that as the result of these artificially engineered business cycles. So I think this will be exposed. That is, even if the Fed does blink and begins to lower rates, that may temporarily stabilize things, but the problem is you're still going to see these malinvestments not producing the sort of sustainable income reinvestment and generation that will allow us to come out of it in any semblance of a healthy economic recovery.
Not going to be enough to
Just
cover
not
the debt load. So
absolutely.
The debt is going to continue to increase, and that further weakens the currency.
That's right.
Because it's going to be monetized.
And the only way then to keep the growth party going is to outright consume your capital stock, which reduces your future potential growth rate and leads to truly horrific potentially multi.
Yeah.
Yeah.
So another way of understanding what you're saying is that in 2008, the patient was essentially close to dying. And they injected the patient with a bunch of morphine, and they've needed more and more morphine at a higher rate of change. And we can see the health of the patient is deteriorated. He's not really alive, no matter what they say. So they really have no ability to save the patient at this point. They have to do away with this patient altogether. That's the problem, is we've never really solved the core issue with what happened.
We've made it worse. We've made it even worse.
I mean, it's a good point. I mean, one of the success stories that we saw in the United States that is, in my view, a direct consequence of Fed policy is the whole boom in shale oil, right? So this is one of the few growing areas in the U.S. economy other than tech has been this gigantic boom in shale oil and shale gas. In my view, none of this would have been viable in a normal interest rate environment. It's just not possible, right? These things do not, at these prices, they could not have grown at these levels. Just to kind of give an understanding, right? The world consumes about 90 million barrels of oil per day. And it's growing at around 1.5 million barrels in a normal growth environment. The US production growth was close to 2 million barrels this year. So it has outgrown it has grown more than actually world
But
consumption
that
has
composition
grown.
is shale.
It's all shale.
So that has that 90% decline rate in how many
It has
years?
about 70% decline rate in the first year.
In the first year.
In the first year, and this actually got, so there's a big difference between shale oil and shale gas, where in shale gas this decline rate is about 30% in the first year, and shale gas is older than shale oil, so we're doing this for a lot longer, and the producers actually have managed to bring these decline rates down. So initial production is less high, but the decline rates are a lot less. And so you have actually a bit more stable production. So you can actually build on this. In oil, it has been the opposite, because what these guys have to do is they have to service the debt. So they try to get as much out as quickly out of the ground. So these initial production rates have actually skyrocketed, but at the same time, these decline rates have been worse and worse and worse. And so far, they just have still been showered in money because people don't know what to do. None of these companies should get basically the lending rates they're getting, but they do. And so they keep on doing the only thing they can do. In a way, they're a little bit like a central bank. There's only one thing they can do, right? Is that they can just produce more. Yeah. And that's what they're doing. But if you raise interest rates, I mean, there's not a single survivor, right?
The chief difference here between a central bank is, in this case, there's natural scarcity. So they can't just draw down. There's not unlimited.
Yeah, no.
oil.
I mean this jokingly,
yeah.
right? But it's basically the central banks.
In a way, we're also
however they repackage what they're doing, whether it's QE or lowering interest rates. In the end, it's printing money. I mean,
well, but what's interesting to me here is we've printed money to do something that was non-economic, using the state of our economy, and by doing so, we've basically plundered our reserves of energy from the future, hydrocarbon energy, which is, as we know, the best source of energy.
You've severely misallocated resources, and these things will only subsequently become apparent.
So that will, for example, cause a reduction in household formation.
Absolutely.
Because we simply won't be able to have as much energy going around. And these are the kind of connections. I mean, Ned, what do you think about why can't it just be a reduction in rates? It doesn't have to be 5%. You know, the argument that these academics will always say is, look, 2008 was exceptional because it was systemic. There were systemic problems with the plumbing system. From now on, we've taken care of that, so these will just be recessions. And recessions we know how to deal with just money printing. So Ned, why do you think that this time around they can't just lower rates and solve a recession that way, or smooth out the business cycle, so to speak?
I think it's a combination of the loss of purchasing power becoming too obvious. I think that would accelerate. I think we all agree that we're losing much more purchasing power than is obvious on the screen anyway. So I think that's the first reason. The second reason is what I said earlier, which is I think the bond market I can feel that it's at the end of its tether with where we are at the moment. But I think also, just to cycle back to some of the threads we've been talking about here, the blame game, and you mentioned the patient dying in 2008. So for me, there's a real cyclicality to that too. I think the patient died in 71, and then it took, the full 37 years for it to die again, and it's been pumped up again. And there's another real obvious similarity between that period of the 70s up to 1980, 81 with where we are now. Populism, petrodollar crisis. I see Venezuela and oil as potentially the thing which is really going to do it. Because if oil goes here, then I think that what we're already looking at and what we're already observing and worrying about in terms of loss of purchasing power can become really, really obvious really quickly. So I often talk about this. 71 was the first pull on the one-arm bandit. 2008 was the next. Interestingly, the amount of time between 71 and when it became really obvious in markets is actually quite similar to QE to now. So it seems to me that the transmission mechanism for these kinds of policies is about 10 years, give or take a bit one way or the other. But actually it's oil, it's energy, because the market will allow itself to believe any narrative it needs to in order for people to just carry on doing what they're doing. Well, people like us, we're not normal, we're not we don't think like most people who deploy capital. They want to just carry on doing what they're doing. So they don't want to challenge that narrative. So for me, it's what makes the market challenge the narrative is very likely to be higher oil prices, and it could well be Venezuela. And I agree completely about the blame game. It seems very convenient for China and Russia to be put in the middle of this conversation about money, about financial system at this point, and Venezuela and oil and all of that comes together as a heady mix at this point in the cycle. So I think it's the late 70s, as John was inferring. I feel that's where we are, and I think it's because the loss of purchasing power suddenly, as it happened in the late 70s, it got too much, it became too obvious, and then people do move. What was already apparent becomes that much too obvious.
Can I add to that? Now, your reference to the late 70s is interesting because when Volcker raised interest rates to, I think, 20% at one stage, if you look at the growth of broad money, in those days it was M3, it hardly faltered. It continued. In other words, the money was made available by one means or another to rescue the people who were badly affected by those ultra-high interest rates. There is another aspect of this which we haven't mentioned so far, and that is when you print money, you are transferring wealth from one person to another person, one group of people to another group of people. And monetary inflation, and particularly the very heavy monetary inflation we've seen in the last 10 years, has effectively transferred personal wealth away from the productive side of the economy to the financial side of the economy, which is not the same thing, and to government. So in other words, we have seen an accumulating burden on the productive side of the economy as a result of monetary policy over the last 10 years. Now, does this give me any hope for some miraculous Lazarine recovery? No, it doesn't. I'm afraid it's going to be very, very difficult to get out of. And the only solution that the MMTers and all the rest of it actually see is print more money. So the situation, I think, as far as the underlying economy is concerned, is going to get worse. There is an interesting parallel with this. If you look at Germany post-World War I, this is becoming my favorite topic, really. If you look at Germany post-World War I, because of MMT and George Knapp and all the rest of it, with his chart lists, the German central bank and the government only knew one way of raising finance, and that was to print money. They'd been doing that through the First World War. After the First World War, it began to affect the purchasing power of the mark very, very severely. They didn't raise taxes at all. Taxes actually were a very small part of overall government revenue raising at that time. It was the printing of money. We have a similar situation. It's not as rapid or as violent as what happened in Germany, but the only increase that we're seeing in the financing of government revenue basically is by printing money. Either printing money directly or indirectly by encouraging the banks to expand bank credit to directly or indirectly finance increasing budget deficits. So we have got a similar situation, if you like, in terms of money to what actually happened in Germany post-First World War. It's just not as violent, but the end result is going to be exactly the same.
What's particularly scary in that scenario is that if you look at what Herr Havenstein, who was the governor of the Reichsbank at the time, was saying, he was printing money in order to save the economy. How many times do we hear that from central bankers today?
Exactly.
It's the exact same logic,
Yep.
And that to me is, I think, a very scary thing that we should all take notice of.
Yeah.
Maybe one comparison also to the Volcker years was that government debt in terms of GDP was significantly smaller than it is right now. So if you increase, I mean, these are crazy numbers, right? But if you would raise interest rates to 20%, if they would be forced to raise interest rates to 20% to stop inflation in some way, there's no way they can pay the interest on that, right? So that's just not an option. Plus, also, you had then in the 80s, there was another, like, you could get out of this with a lot of market liberalization, right? That's not something we have right now, like another weapon that we could pull out and say, okay, we kind of kickstart growth with that as well. So I think the situation now to the 1970s is very different. And then also, I think one point is important to notice that this is kind of, we had a coordinated effort globally to increase debt, to increase sovereign debt. I think we have never seen something like this before in human history, that everybody actually increased debt.
Yeah. And we put it on bank balance sheets with zero risk rating, so it's
exactly.
not considered a capital allocation against bank leverage ratios.
So this is not the same situation as we had during the Volcker years at all, in my view.
Yeah.
I mean, this is not even the same situation as we had in 2007, because at least there we had China, for example, that came to the rescue, which had very little debt to GDP, and basically aggressively stimulated its own economy and bailed out the rest of the world in 2009.
And that's the problem with this sort of modern version of what is effectively a neo-Keynesian policy. That is, every time one country gets into trouble, other countries can stimulate to try to bail it out.
Yes.
But the problem is, there's a net negative there if the total debt of the entire system grows every time you do that. And the fact is, you reach a point where the whole Earth is so saturated with debt, the only option then is to stimulate lunar demand. But there's no natural demand you're going to get from the moon. That's the end game. And yes, exactly, with China and other emerging markets having been there to help things recover from 2008, however artificially, there's no one else.
They stimulated commodity demand,
all
right?
Of it,
so
all
for
of it.
example,
but there's
so
no one to step
out,
up this time.
They bailed out a lot of commodity producers by just stimulating their economy and building massive infrastructure projects, building strategic petroleum reserves in China. All that helped these petro economies actually to recover relatively quickly from the financial crisis. And we're just not in that situation anymore. We can't do that a second time.
I think something that's worth mentioning, though, we talk about the central bankers and the outcomes and everything, but it is worth bearing in mind that most of the central banks have all of this in mind as they carry on all of this anyway. And that's why, whether it's G7 central bankers with 30% of their reserves in allocated gold bars, or whether it's G20 at 20%. For me, they know all of this. We may be having, a conversation full of insight, but I don't think many central bankers would necessarily be learning that much from us. They know this stuff already, and for me, they're managing it. But the issue is for the average person, which is why this is a worthwhile thing.
But they could still become Goldmoney clients.
Well, maybe. well, maybe. But the key here is that it's anybody below the super rich. So I'd put the central bankers above that. They don't know these things, and they are not positioned for these big cyclical changes. But for me, the central bankers, they hold lots of money and lots of credit that they know really is worth nothing, and they're positioned for these changes so long as the narrative is controlled and the solution is delivered. That's all fine. The issue really is for the average person to understand that they need to be well hedged through the cycle, and certainly I would include most people in the market, so not the super rich, but the people who are investing other people's money and the people that I meet. Well, they don't know this stuff.
And to your point, Ned, I mean, it's interesting when central bankers get together at the Bank of International Settlements, the narrative completely changes. They're deeply worried about the state of things. They're deeply concerned about that there's still too much leverage in the system, that a lot of these assets that have been pumped up in value in recent years can suddenly go illiquid and cause another banking crisis. So they almost have this alter ego talking shop in the BIS, which is somewhat supportive of a lot of the narrative here.
Yeah, I mean, for what it's worth, I happen to have an ongoing conversation with Bill White, who used to, used to be chief economist there. And his view, and I don't want to speak for him, but I'm confident he would say this now, is that they are only going to print. I mean, that's it. We sort of look at him like, well, what's the plan here? And the answer is there is no plan, just like has always been the case before. But I think the plan is you do that because you know that you're holding money. So in other words, they're actually balanced out. As long as they have the right quantum there to offset that issue, you're basically balancing money, credit, and narrative, and it's the management of the three things that's really going on. And we can get quite focused on individual elements of it, but really they're doing all three at the same time.
And they don't want the ship to go down on their watch which is where the control element comes in.
Yeah.
Of course, yeah.
Or the control fraud, if you want to call it that.
Yeah, the duplicity, talking out of both sides of their mouth, which is basically what we're saying.
So Ned, that was a really interesting point. So I guess you're quite confident, sounds like everyone's quite confident that we're not going to see something like a deflation in purchasing power for the rich through, say, taxation and other mechanisms, while the productive class sort of becomes empowered with, an MMT or some kind of an economic policy that, creates wage inflation and keeps the economy chugging along.
Well, not for me. I think this is all just theoretical stuff. I think the market is telling you a story already that investors don't want to own cash or even near cash instruments anymore, and I see it every day when I go out on the road. So for me, any genuine move in that direction is going to lead to people pulling up the chairs and buying those. So I just don't see that as a real viable outcome in markets. I think the direction of travel is already set, that people are very, very nervous already of owning those things. And I think that if policy headed in the direction of MMT, you'll see the outcome pretty quickly.
So what's your big, most positive view and where prices are going to be going next year? What market do you like the best?
Well, unsurprisingly, James, I like gold and silver like you.
Yeah, I know, but beyond gold and silver. What about tangibles generally? Real estate? Farmland?
Well, I'm not sure. I'm not going to make a prediction on that. I've long since bailed on making broader market-based predictions. I think that what is clear is that people are now at the margins becoming more and more aware of the fact that stair-step central bank interest rate increases and it's all fine and there's fairies at the bottom of the garden and stuff like that. That's losing traction, and I think that bleeds across into lots of things. But as to which asset classes beyond the one that I invest in, I'm not so sure.
Yeah.
There is an answer to this, and again, going back to the Weimar Republic. Foreign students who were receiving dollars, sterling, whatever it was, at universities in Germany at that time, lived a most fantastic life. And out of their foreign exchange payments from their parents, they were even able to buy property. So that gives you an idea of the primacy of sound money in that environment. It is the best form of preserving your assets, your wealth, if you like, that you can possibly have. Property, obviously, is down there somewhere, but it's quite a long way underneath gold or silver or whatever goes for money. And if you look at other things like the stock market, if you adjust that, the best performing markets in 2018, if you adjust them for the loss of purchasing power of the currencies, it's an absolute disaster.
Now, Alasdair, you raise a really good point there when you use the term sound money. And I think we started off this program today with a very sophisticated level of economic knowledge, and obviously our client base and viewers are generally very intelligent and understand most of what we discussed. But let's just take a moment to talk about this concept of sound money for someone that we're just tuning in for the first time and try to understand it. I personally find that when I travel the world and when I interact with people, especially from my generation, they have no idea what sound money is. They don't really have a good grasp of what money is. And I think it would be very interesting and valuable for our viewers if each of us maybe took a turn to explain, very briefly, what is money and why is gold money? Why not other things? So perhaps we start with you, Alasdair.
Thank you very much. Gold throughout history has been sound money. And it's been sound money because it has always had a value attributed to it in a non-monetary sense. You've only got to go back 3 millennia and see Tutankhamun's mask and just marvel at the gold, which looks as if it was cast yesterday. It's just incredible. Also, I see you're wearing a torque, of sorts. Celtic art produced the Snittersham torque, which is the most amazing piece of electrum, which is a mixture of gold and silver, but predominantly gold. And the artistry in this. So we can see that there is real value, tangible value, as far as humans are concerned, in gold. And the fact that it is completely incorruptible makes it useful as money. And particularly when you compare it with government source money, the point about it is it's nobody else's liability. You buy dollars, you're buying into the full faith and credit of the US government. You buy sterling, you're buying into the full faith and credit of Mrs. May, or whatever. This is the thing that differentiates gold from paper currency. It has a track record, it is incorruptible, it has always been accepted as money, and when times get bad, it will come back as money. It is already used as money, and without interruption, in places like India, China now, China particularly since it became legal again in 2002 for individuals to own gold. So you've got huge areas of Asia which still use gold and have used silver in the past. I mean, first time I went to the Middle East, and I think, James, your experience would be the same. The Maria Theresa dollars, which were being printed or produced pure silver, even in the 1950s and 1960s, was the primary form of currency for a lot of people in that area. So that basically is what sound money is. It is money which is beyond the control of government and is accepted by people as the incorruptible unit of exchange or counterparty of exchange, if you like, in transactions. And it's really as simple as that.
Ned, what do you think? What is money and why gold?
Well, look, it's obviously a big subject, and there are many ways of making the same point. I like the, I don't know whether this is actually true or not, but people refer to the idea that paras and SAS and Navy SEALs are dropped into enemy territory with small gold coins in their belts. I don't know if that's exactly right, but this brings up all sorts of points which are, it's all to do with recognition for me. I mean, these other things are important, fungibility, but it's that thing of recognition. It's the combination of time, recognition, the fact that everybody everywhere knows what gold is. That's what makes it money, and that's what makes it beyond the need for a stamp of approval. So again, to try and keep the language relatively simple, what is the case at the moment is most of your transactions require all sorts of stamps of approval, whereas if you land in Mongolia or in the jungle, people are going to accept gold and probably silver in exchange, and that for me is what makes gold and silver money.
James?
To me, sound money is money that you own. It doesn't have counterparty risk. It's a tangible asset. And I think the thing that most people don't really, a lot of people miss, is that money comes into creation the same way all goods and services come into creation. It's applying hard work, applying capital, and pulling money out of the ground. It's a productive capacity. And the beauty of gold is that it's timeless. An ounce of gold today is exactly identical to an ounce of gold 1,000 years ago. It doesn't disintegrate, it doesn't tarnish, it doesn't rust, it doesn't do anything. And that timelessness makes it an ideal unit, those weights of gold, an ideal unit for measuring prices, economic calculation. How do you invest capital in different opportunities? So to me, that's sound money. It's gold.
John?
And let me just add, silver is a gold substitute in my view. It's got a lot of the attributes that gold does, but it's complicated because it also has industrial components. Whereas the supply-demand for gold is entirely monetary, silver has an industrial component. So I look at the ratio of the two, and when the ratio is high, as it is at the moment, I see silver as an attractive alternative of a way of diversifying your gold portfolio.
It's also more abundant.
Yeah, it is more abundant.
So it's always going to be a little bit less value dense.
Exactly. There's more of it in the Earth's crust than there is gold.
John, what is money and why gold?
Well, I would just emphasize the medium of exchange aspect of it, because really money is what enables you to get beyond barter by having some intermediate good that you can use in third-party transactions where direct barter is not possible. And that enables civilization to exist, really, because to get beyond the family unit, the tribal unit, you need to have some means of trading with people who you might never even meet, but you do so indirectly through the use of a medium of exchange. That, to me, is money. However, what you see universally the world over is that those substances, including, of course, gold, that have ever been used as money are ones that are more or less universally accepted, and they are universally accepted in large part because, as James says, they don't decay, and their storage costs are effectively zero. That is, there's no cost involved in holding on to some of the stuff, and potentially holding on to it for your entire life, and maybe handing it on to the next generation. So human societies, the world over, have solved for this ideal money, which is gold. It has been for an awfully long time now the most universal money, notwithstanding the very prominent role of silver for more day-to-day transactions as opposed to a store of value for particularly large pools of wealth that has tended to be more the role of gold.
Stefan?
Yeah, I would build on what James said, which I wholeheartedly agree, and basically add that there's an energy aspect to the whole thing, in that if we have a society which is prosperous, you generate an energy surplus and you turn that actually into money. And the best way we found through try and error is to turn this into gold. So the gold industry is anchored in the primary industry. So as you said, you're using the same capital, the same time, same labor, the same machines, etc., to mine for commodities we're actually consuming, like oil or copper or anything. We actually mine for money, and gold has simply turned out to be to possess all these attributes that are needed actually to create a vehicle that allows you to transact and to save. And the lack of entropy of gold, for example, is a very important aspect of this. As you said, or as Alasdair said, the Tutankhamun's mask still looks like it's brand new, and it will still look like, unless we destroy it somehow, it will still look brand new in 10,000 years from now. You don't have to do anything with it. So I think this aspect that you actually are able to store your energy surplus and use it for saving a transaction is a very important part. Why, in the end, it's not that we chose gold, we just found it in the end. It was there, and it just made the most sense of everything there was. If there wasn't gold, we would have had to invent it, actually.
So I'll go last. I agree with all of you guys. I think you've all provided great explanations. The question that's always bothered me about this is why? Why is it that when you go to Mongolia, people value gold? And why is it that when you go everywhere else? And the solution to this question, to me, came from a deep knowledge of physics and chemistry, where you basically figure out, as Newton did, that in the corporeal world, in the material world, everything follows these laws, these principles that are repeatable, observable, omnipresent, and don't change through time. And all of this stuff is ultimately made up of these simple building blocks of the stuff called the elements. And for whatever reason, this element gold has two attributes which are clearly observable, clearly repeatable, clearly omnipresent, and clearly transcend time, which is that it is rarer than all the other elements. So it's always going to take more energy and more time and more labor to get a physical amount, say a sugar cube of gold, than a sugar cube of silver, or a sugar cube of copper, or a sugar cube of oil. This is just nature, natural scarcity enforcing this rule. But then it's got this other trick, which is that that sugar cube of everything else begins to react with air almost immediately, and gold doesn't. So the result is that over cycles of human life, we see that everything else is either used up or actually doesn't survive, and gold does. So to me, going back to the question of what is money, money is basically a social tool for us to cooperate with each other once we've decided that we don't want to be a clannish society. If we want to be in clans, we don't need money, because we can essentially cooperate with each other through familial relationships, kinship, barter. But once we leave the clannish society and become a non-clannish society, there become different segments of society that depend on other segments. So the primary producers, the farmer, is always going to be producing the food for the rocket scientist. Putting aside who's better today or tomorrow, it is a fact that the rocket scientist and the professor and the central banker is dependent on the farmer. And for them to cooperate, they need to have something that intermediates their cooperation, a social contract. And that's what money is. It's this tool that allows the farmer to create more crops than he needs today as a surplus, which he can then trade on with other counterparts in the society for something that is better than his own crops. And it allows a software engineer to trade his labor, whereby he wrote some lines of code, for something that is better than lines of code. And it just goes back to that periodic table, how everything is not as good as gold or doesn't last as long as gold. And so to me, in probably what is a more provocative point, money is gold. Gold is money. You know, it's basically, there is no other system. The laws of nature would have to change. But so long as the natural order is the way we have understood it, and as Stefan and Alasdair have stated, the other mystery here that we should revel in is there isn't an example of us not using gold as money. There's been this great attempt by modern historians to essentially put together this anachronistic mishmash of examples of clannish societies using a big ring in the island of Yak, or clams and shells. But these are just examples of clannish societies, kind of like inmates using cigarettes in a jail. Because all you have to do is take a look at that period of time and zoom out, and you'll see a civilization that's using gold and silver as money. So to me, so long as that was taking place throughout written history, the period of history we can objectively date and back into, that is a great mystery, that we've always been using gold, that gold and silver have always been money, which reconciles with our natural understanding of why these elements are so special. To believe that gold wasn't money, you have to either take some small clannish society and argue that they were even using money, or you have to believe an anthropological theory that isn't objectively dated. So you're getting into paradigms like carbon dating and things like that. So to me, money is gold, gold is money, and that is why we're so focused in this company at promoting this message to the average person.
Stefan said something interesting. He said if gold didn't exist, mankind would have to invent it.
We can't.
Which brings us to cryptos.
Great segue. Yeah.
We have to say something about cryptos.
Well, I was trying not to say it after our terrible predictions last year, James, but well, it's very interesting. As you guys may know, I wrote a paper about this where I, made certain predictions about what would happen to crypto. I definitely made a lot of money on the way up as well, knowing that, how I believed it would end. It doesn't look good for crypto, in my opinion, right now. It's something that I say, unhappily, because I have still a lot of investments in the space, especially in the crypto mining industry. It doesn't look good to me. It looks to me like, at the end of the day, history will remember this as just another fiat currency attempt. What do you think, James?
I think it has more of a future than I think you do. And from a big-term, long-term perspective, I see this as a leg up, and now we've come down to a correction. A little bit surprised and disappointed that we broke 6,000 on Bitcoin. I thought that level was going to hold before we moved up. But ultimately, what will drive it, is there a need for crypto? Obviously, if you have gold, you don't need crypto. But there's still a need for crypto in many parts of the world. It does have some unique advantages. It is what I call an escape currency. It enables you to leave your country through a currency if you have exchange controls. So it's a free market mechanism. It was created for a need, and that need still exists to some extent. And if we have a financial crisis in the future, I think cryptos will do well, but of course not as well as gold will do.
Yeah, James, I like what you say there. I agree with you. I've been saying to people that until we get capital controls, over obvious ones, the utility is just not there. And I think then you're right. It goes back to being not about the price so much as about the underlying core utility. I have plenty of friends that are quite deeply involved in the sector or the space, whatever you want to call it. And I think that, that there is a real thing happening here, and I don't think it's dying. I think if anything, it's growing really in the background. I think the price action is one thing, and the end game of it is another. But I do think that there's a point that I touched on earlier when I said gold's about recognition. I think that's one of the biggest problems for crypto is, and I said this to the guys, I was lucky to meet the people, a bunch of the early developers behind Ethereum quite early on, and I was in a meeting with them all as the one sort of gold bugs sat there. And I said, look, the problem you're going to have here is the average person is not going to buy into the idea that maths is better than the liars in the state. Now, I know that seems absolutely ridiculous, but it comes down to this point about recognition. That's what makes gold money and what makes crypto not really money, but potentially functionally still, I think, very interesting. And what I will always say is I've been talking about these things we've been discussing today for 20 years, and up until, well, very recently, no one cared at all. And then Bitcoin came along and did the most incredible amount of heavy lifting, discussing what money is, how it should be, how it could be, and energizing young people about this conversation in a way that gold didn't do, and arguably maybe couldn't have done. So I think it's still very relevant and interesting. And I think, capital controls.
At the last roundtable, I said, we don't call it crypto money, we call it cryptocurrency. And I always like to make this distinction between money and currency. Gold, money is gold. I agree with you 100% on that, and that is the only form of money. But we have these other currencies, a variety of different types. Some are national currencies, some are cigarettes circulating in a jail, as you've used. And you've got cryptocurrency, and it does have some utility from time to time. So I do think it has a life.
John?
Well, look, I mean, I recall last year when you asked me, is Bitcoin a bubble? Is cryptocurrency a bubble? And I said, well, define bubble. And the fact is that we mustn't forget the dollar itself, fiat currencies themselves are bubbles. They're printed by governments that are increasingly indebted, that are suffering now or fighting against populist uprisings because they've arguably mismanaged their economies for a sustained period of time. And as we discussed also today, be it MMT or some other sort of ex post reason for doing it, politicians have this tendency, when in doubt, print. Central bankers, when in doubt, print. So all these fiat currencies are bubbles, and I think really the elegance of Bitcoin, that is the proof of work algorithm concept, it's a very powerful one that's drawn in a new generation to thinking about what is money. What should money be? Is money being, is it serving society? Or is it perhaps not serving society? These are good questions. They should be asked. They need to be asked because the fiat currency world we inhabit is itself a bubble. And so I find it refreshing that we're even having this discussion. However, I absolutely positively believe, as I wrote in my initial essay on the subject of cryptocurrency back in early 2014, I believe that gold trumps all of these attempts at imitation for one ultimate reason, as well as the other ones listed here. One ultimate reason: it trumps everything created by man.
It's not an abstraction.
Exactly.
And as we know, every mathematical system is incomplete. That was Kierkegaard's incompleteness theorem. So it has to rely on a previous rule, and when you extend that into computation, that still holds true.
I agree.
In other words, you've never seen a piece of technology survive cycles of time. In fact, entropy in informational theory and technology is one of the most important aspects today. It's how artificial intelligence is done. Entropy is going to hit this stuff like a pile of bricks because it's based on abstraction, and it just goes back to that periodic table of elements and how we generate our food. The same toil that a human has to inject into creating the food that we eat to survive, that ephemeral energy surplus, is the same toil that has to go into getting gold out of the ground. The mining of cryptocurrency, and I speak from experience having one of the largest cryptocurrency mining companies, is not the same. It's taking place at the service economy, where all those people are getting subsidized energy in order to sit there in a campfire, essentially, waiting to solve this puzzle. It's not a primary economic activity at all, because in a primary economic activity, you're dealing with natural scarcity. And here, you're not really dealing with natural scarcity, you're dealing with an algorithm that creates faux scarcity. And that is another problem I think we saw with crypto, where we started to see all of these different versions, improved versions, fundamentally improved, because paradigms change. And we see that in information and data and computation. So my issue is that while I totally agree on the macro backdrop for why this should continue, remember that the cryptocurrency only gains its value at the point of exchange with another currency. So for what you're saying to be true, for it to be even be treated as a currency, we would need to reach the point where people are willingly accepting the crypto as crypto and then spending it as crypto, measuring it in crypto. And I don't think that's going to happen because of this flaw of it being an abstraction. You can't measure an abstraction in an abstraction. It has to have some anchor back towards reality. So you have to measure it in energy, you have to measure it in dollars. You need some kind of a connecting tissue between the abstraction level and the real world.
If you look at Dow theory of asset prices, generally there are three phases. You have the initial phase where investors get involved who are really on the inside and they understand there's something going on. You then get a consolidation of sorts, and then you get a second phase where the smart money begins to move in because it realizes that this is something that is going to make smart money money, if you like. Then you get another consolidation, and your final up phase is when the general public really get involved. You know, it's a surefire thing, and you know, in the terminology of 1929, the bellhops are telling you to buy this, that, and the other thing, and all the rest of it. Those are the three phases. The problem we have with looking at cryptocurrencies is we saw all those three phases in Bitcoin up to the end of 2017. The question then is there a bigger phase where those characteristics are repeated? Now, it is possible that that is the case, and there are two things that make me say that. The first is there have been moves to try and introduce Bitcoin in particular into the sphere of regulation through futures, through ETFs or mutual funds of one sort or another. Those have had very, very mixed results. The importance of that is that it does open up Bitcoin in particular. I'd forget the other currencies, cryptocurrencies for the moment, but it does open that up to institutional money. It needs to do that if we're going to have that second broad up phase. Then there is another consideration, and that is what is actually happening to what the cryptocurrencies are measured in, and that is fiat currency. If the world comes to some sort of financial end or stop because there is a bank crisis, you know, a systemic crisis, or inflation really takes off, you're going to have a situation where people in increasing numbers want to either get out of banks or get out of fiat currency, or both. Now, some of those will turn to gold. Gold price, presumably at this stage, will be a lot higher. But if we look at the young of today, the sort of, you know, the people who have been born in the last 30 years, who are very much attuned to technology, they're going to move towards Bitcoin, probably Ethereum, I don't know, but let's just concentrate on Bitcoin. So you can see that that will provide an escape route. Now, the reason this is terribly important is because the central banks have effectively cut off every other escape route. You cannot get out of the banking system. You cannot get out of paper currencies. That is the intention. If you want to draw out, you know, £1,000 or something from your bank, you find that the bank asks questions. You want your money, the bank is denying it to you. Why? Because the central bank says you mustn't give out an awful lot of currency. The reason behind this is quite simple, and that is that the central bank wants to control the flows through the whole banking system, and it doesn't want to be faced with the old-fashioned queue in the street as people are taking money out of Northern Rock or whatever it is. Cryptos are a way of an individual saying, I don't want dollars, I don't want sterling, I'm going to give someone else that problem. You don't destroy the dollars or whatever, you just hand them on to someone else in return for something that isn't issued by the government. So it is possible that this bubble could have another phase. I don't know, I really don't know. I note your concerns with great interest because you've taken considerably more time than I have to try and understand and profit from the crypto industry. But I just think we ought to bear in mind that its future is to a large degree dependent on external factors and particularly what happens to the global monetary system.
All right, well, I think we're now headed towards wrapping up this conversation. Before I get to sort of final predictions and summaries, we did receive a few questions from some of our clients, and we've selected some that I think we should try to answer in a rapid-fire manner. So I've got this phone here. I think this would actually be a good one for you, John. First question, could you explain why countries like Japan haven't experienced inflation despite massive interventions by the central bank in the economy? For instance, the Japanese central bank regularly buys government bonds as well as the ECB buying corporate bonds. Why aren't Japan and Europe experiencing hyperinflation?
I think Japan and Europe are in two quite different situations. I'll do Japan first. Yes, the Bank of Japan's created a lot of money, but for largely demographic reasons, the Japanese have a huge propensity to save. And so you just have not got the multiplier effect of that coming through as realized price inflation of any meaningful level. I mean, it's been slightly positive at times, around zero at other times. So they squeezed out a little bit because there is this huge propensity to save. Now, that might change in future, I mean, depending on how the society evolves, and in fact, it probably will. But the other important thing to point out, the Japanese owe this money to themselves. All the debt and all the monetization of the debt, they owe it to themselves because they've not been running an external deficit, needing external finance all these years. And so the ability of Japan to devalue its currency is also limited just by virtue of the fact that they were such a huge net exporter for so many years. And so the imbalances in Japan are domestic, not external, and that helps to support the currency, which has also put the brakes on inflation. The euro area is very different in that regard, because actually, if you look at the euro area in per capita growth terms, they've barely grown at all for the past 10 years, whereas Japan, in per capita terms, has continued to grow. The Japanese economy is actually the healthier one than the euro area in aggregate, notwithstanding certain pockets of strength in the euro area. So really, that just means that growth in the euro area has been so weak and so bad that even the creation of all this money also has not resulted in a multiplier effect. But there are some differences between the two areas.
Thanks, John. This next question I think would be good for Ned. What does the consolidation in the gold mining industry mean for gold prices in the long term?
I don't think it has much to do with the gold prices. I think it says something about the health of the gold mining industry. And actually it feeds back into what I said earlier about the monetary cycle of gold, and we're coming to late spring. I see this in a similar way in the gold mining space. They've been through a brutal winter period. Some of the big mega deals you're seeing, they might look like drunks propping each other up at a bar from a distance, but actually I don't think that's true. I think what's happening now is the need to retain tier one assets is leading to consolidation, and I think that you'll see that trickle down through the rest of the space, and I can expect to see this continue. Some of the tier two, tier three assets will percolate down, but I don't think it means anything for the gold price, because of course the gold price is discovered in the cash market based on real interest rates, sadly, and not on any kind of supply and demand fundamentals. So I take it as a positive sign, but not really having anything to do with the gold price per se.
I totally agree. Okay, I think we can now head towards just finalizing the conversation. Perhaps we can start with myself and then go this way. So I think the most important thing for 2019 is for any viewer that's watching this, that's been watching us for a few years, whether they're just heard about this company and what we do, or has been waiting and waiting, to truly consider why is it that this element gold continues to trade at $1,300 US an ounce at or near an all-time high in virtually every currency in the world. There are 196 currencies in the world, and this element trades at or near its all-time high when measured in those currencies. This guy recently, who's a mining analyst for S&P, said that gold is moderately desired and doesn't really have any utility. And I think that gold has the most utility of any other element just because of its natural properties. And so if I'm sitting here and I'm watching this and I'm listening to all of the people around the world saying that gold has no value, that gold has no place as a monetary asset, you really have to just think about how high could the price go? How high could this next cycle take gold to if you position yourself right now? And what's the downside? What is the downside if you're not positioned? So I would say that this is definitely the year to start buying gold and silver aggressively.
Yeah, I would agree with that. I am bullish on both gold and silver, and part of the reason is I see increasing counterparty risk rising in the year ahead because of the fragility in the financial system, over-leverage in the banking system, too much government debt, and things of that nature. But I'd sort of like to sum up, going back to Sir Isaac Newton. You referred to it earlier, which is appropriate given here we are in the Royal Society. I'd like to explain his role with central banking because I think it sort of gives a little lesson as to how we might move forward today, or how maybe we should move forward today. The Bank of England was created in 1694. The first banking crisis started in 1695, and it lasted until 1697 because of what was called the Great Debasement and led to the Great Recoinage. Now, Sir Isaac Newton at that time was master of the Royal Mint, and he actually put Britain on a gold standard in 1700, effectively. And that gold standard basically laid the framework for the growth of the British Empire and raising standards of living throughout the world as the empire grew. And the key to what Newton did is he put a ball and chain on the foot of a central banker. He introduced discipline into the system that you cannot create money out of thin air, which is what the Bank of England initially did that created the first banking crisis. Now, we've had a lot of banking crises throughout history, a couple of which I've lived through, and I've read about many, many more. But they always come down to central bankers going in the wrong direction and doing the wrong things. So we as individuals, what we need to do is forget about central banks, be your own central banker, buy gold and silver, and sleep sound at night, because at the end of the day, that's what it's really all about. You want to take those decisions, preparing for an uncertain future, and the best way to do that is to have some gold and silver in your portfolio.
John?
Well, yes, I'm bullish as well. I mean, no surprise there. I mean, just a quick response to James referring back to Sir Isaac Newton putting a ball and chain, as it were, on the banking system by pegging to gold. I mean, there are other nice analogies there. You can talk about golden handcuffs, right, that prevent central bankers from using the printing press. But that kind of has a bit of a sort of criminal association. But my favorite is perhaps the
Purposefully chosen by me.
But another useful metaphor is gold as a monetary straitjacket that is also preventing them using the printing press. But that implies that they might have lost their minds. But in either case, yes, gold constrains central bankers. But the obverse of that is that it enables individuals to preserve their purchasing power even if you get into a severe financial crisis. We've seen this repeatedly throughout history. And so I think that there are three good reasons to be bullish the precious metals as we enter 2019. First is just straightforward macro. Central banks are beginning to blink. They see that having increased interest rates marginally is already leading to an economic slowdown, which, given the continued fragility of the banking system, is almost certain, perhaps, to lead to at least a minor, if not major, financial crisis. So that's a bullish gold argument in of itself. However, one thing that did happen in 2008, it shocked a lot of people, and a lot of people who had never bought gold and never even thought about buying gold chose to act in 2008. And they bought maybe a little gold, or they thought about buying gold for the first times in their life, but maybe didn't actually do it. If you get another crisis, that once bitten, twice shy mentality is going to cause people to purchase an order of magnitude more gold than they did last time around, or if they didn't quite pull the trigger, they'll be more likely to pull the trigger the second time around. That will be a qualitative shift in the demand function for gold that could lead to a qualitative jump higher in the price. Third possible bullish factor, although this is probably longer term. Look, I mean, if, as Roy said, many currencies have lost an awful lot of purchasing power in recent years. The dollar has been a relatively good performer. If even the dollar begins to succumb because of MMT or whatever else being implemented in the US, you can make a case that at the international level, the dollar's reserve role will begin to diminish. But to be replaced by what? I would argue that, in fact, central bankers' proclivity for holding gold reserves may continue to increase from here, not just Russia and China and a few others, but a majority of central banks. And that would be a third reason to be quite bullish on the gold price through 2019 and beyond.
Yeah, I'd like to pick up on the central bank thing, because I think that, well, two things. Firstly, in 2018, we saw central banks, particularly in Russia, and also minor central banks like the Polish and the Hungarian, begin to add to their gold reserves. And we know that China's stance is that gold is money. I think I'm right in saying, Roy, I think you told me that the Chinese for gold is money. Still is. The point about this is that we can see the whole of Asia is moving away from the dollar. Some of these countries are moving away because they don't like being, you know, sort of, if you like, held to ransom. I mean, Iran, for example. Russia as well, China. Now, even India is getting away from the dollar. I mean, they're now bartering for oil with Iran, payable in rupees. So this is a very, very major point. We've got roughly 40% of the world's population moving away from the dollar. At the same time, ownership of dollar assets and dollars themselves, on the last figures, and they're all horribly out of date, but I don't think they're very far different, exceeds the US GDP. In other words, there is over $22 billion invested, both in cash, US treasuries, equities, other things, all in dollars owned by foreigners. They are overweight dollars. So I can see that as 2019 progresses, and if I am right about the signs of a recession materializing into something more serious, then you can see why the dollar is going to get sold big time. That being the case, obviously, gold goes better. And there is another aspect of this, and that is that it's under-owned. In the West, anyway, it's under-owned.
Ned?
So look, I think that the bid for gold at central bank levels are given, really. I mean, I think particularly creditor nations, that's sort of there. It's been there for a while. I don't see that as a necessarily a big trend change. What I do think for this year, and is really interesting, is what we saw last year, and I think it will increase probably a step change stronger, which is the language. That's the thing that shocked me a bit last year, was that you're now seeing policymakers, politicians openly discussing the petrodollar system. I mean, Juncker at the European Parliament saying, why is it that we're using the dollar when only 2% of our energy imports come from the US? This seems like a crazy situation. I mean, I could list a whole load of these very serious high-level policymakers that are openly discussing changes to the monetary system. I think that trend will continue, and I think that's a really big deal. If I was going to come up with something a bit more spicy, as a not necessarily a forecast, but something to watch out for, is that the central bankers are broadly fully allocated. They're not all, but you know, that's how they hold their gold. The super rich, not the case. And I think that it's very important to keep an eye on all of this gold that's owned in credit form in the banking system by the super rich. I think it will take very little for that to really cause a big change. Because I think if you see, you know, a sultan or someone realize that what they own is credit risk and not gold, I think that can snowball in a remarkable fashion. And as we all know, being relatively close to the source here, there is no float, there is no physical available. And if that happens, I think that's a big problem for the banking system. And that would be my big outlier to watch for. Whether that will be publicised on the front page of the FT is a slightly separate
Unlikely.
point. But I think that's something really important that people generally don't discuss.
That's, if I might just add, that's exactly what the 1930s was. It was a bank run. People didn't want the paper, they wanted the gold. And you just saw the gold reserves being drawn down. So you're implying that that could happen again.
Yep.
Well, I mean, James, you know that full well. I mean, the physical availability is minimal.
Yes.
And the gold credit obligations in the system are absolutely enormous.
Yeah.
So yeah, I think that's a really important variable.
Stefan?
Yeah, I think what really changed for me, I mean, we've been doing these roundtables for a number of years now, and every single time we came to these wrap-ups and outlook, it was always the expectation that the central banks, and particularly the Fed, at some point will be able to raise rates a little bit, right? And it was always the risk that as they're raising rates, real rates actually are going to increase and gold is going to drop. And our argument was always, we actually think that even if they raise rates, a lot of it is priced into real rate expectations already. So they would actually have to, at some point, be so successful at it, signal that they can go above the 3.5 they have been predicting themselves, and we would have to have like the market belief that we can go to 5-6%. And I think for the first time, this view is firmly off the table now. And that's a total change. So we're no longer, like in the past couple of years since like the peak and prices came off, we're no longer in the situation where we basically have to worry how gold is doing until we get to the point when central banks start signaling, okay, we reached the top. Because they're clearly signaling now we reached the top. And I mean, the shocking part is nobody but the Fed has done anything. So it's just the Fed has raised rates well below what they actually have signaled, which would not have been enough to counter any form of recession. So this actually makes me, I think I was fairly neutral to positive over the last couple of years. Every single time this question came up, I'm going fairly into the bullish camp now. And simply because even if they can kick the can down the road for another 12 months, we are very close to the top of hiking rates here, in my view. And then, I mean, just like rinse and repeat. It's just going to be the same thing as we saw last time. They will slash rates and do something which they think nobody would have seen coming to get the machine going again. And those things are all bullish gold.
Wonderful. Well, I'd like to thank the viewers for joining us for the fourth Gold Money Roundtable. And thank you all, gentlemen. It's really a pleasure to be here with you in this magical place. And hopefully our clients will do very well in 2019. Thank you.
Thank you. Thank you.